Hey, in this video, I'm going to talk about some life insurance policy provision regarding policy loans. So you take a loan against your policy. So first one is automatic premium loan. This is the clause usually included in your cash value life policy. With most life insurance policy, if a premium is not paid by the due date, it's also not paid by the end of the grace period, the policy will lapse. Many cash value policies have an automatic premium loan provision in the contract that can prevent a lapse from occurring. So how it works, at the time of the policy normally wouldn't lapse. If adequate cash value exists, a policy loan is created to cover the premium due. An automatic premium loan can operate as a policy safety value in event that client is hospitalized, traveling, simply misses the payment, and the policy will stay in force after the grace period. So this is great. So if you have a whole life or universal life policy, so you have a whole life. So basically you have a fixed premium. Let's just say you pay monthly or pay annually. So if you forget to pay it, or if you in some situation you couldn't pay it, you should have an automatic payment set up. So anyway, so in somehow you couldn't pay it, right? So you forget about it. Then you this provision actually can help you prevent your policy lapse. So this is very important that if you own a whole life policy. So they basically say, well, if you not pay, so we just gonna automatically withdraw the cash value as a loan, then to pay the premium. So the provision prevents the policy lapse. In fact, some policy will last for years using the automatic premium loans to keep them in force. Yeah, if you have a large, if you have a whole life insurance for 10 years, 15 years, then somehow life getting busy, forget to pay it, you have a huge amount of cash value. So those cash value take out to pay the premium probably can pay, a year's. Then interest on the loan is due on the policy anniversary. If the payment not occur, the loan amount increase due to the interest. So you can see your loan will be increased on the interest. This is like a compounding. So your loan will increase. So you can see some people may forget. A policy owner may realize that the premium payment have ceased and arrive at the false assumption the policy has lapsed. So some people may think about that. They bought this policy, they forget about it. Then, somehow they forget to pay the premium. They assume their policy lapsed. They say, okay, nothing there. You had this whole life insurance for years ago, so you didn't do anything about it, so you think this policy was gone. However, because of this provision, the policy is still in place. If you die, your beneficiaries still receive the death benefit. So that's great about this provision. So we're going to talk about another, basically policy loans. You have a standard type policy loan under the previous APL automatic premium loan. So that's two type of different loan. Here we tell you two type of different loans, right? Then another standard loans say a policy owner may borrow the entire cash value of the policy less than amount that is equal to the interest due to the next policy due on the next policy anniversary. So basically, if you let's say you have $1 million policy, then currently you being paid for a few years for this policy, you have a cash value. Let's say you have a $200,000 cash value. You actually can take out a loan against this cash value. So let's say you take out a loan, if it's 10% interest, so you have a $200,000 10% interest, so you $20,000 interest on the loan. So basically, you can borrow is here said is less than the amount interest is due. So you can borrow maximum $180,000. So most insurance company charge interest arrears. So after that. So basically say, if you borrow $200,000 against your policy, 10% interest, you annual interest that you may have to pay the interest at the end of the year. However, some insurance say, I want you pay the interest at the beginning when you borrow the money. So that's in advance. So companies that charge interest in advance may say they have a lower interest rate. However, because it's charged in advance, it often equivalent to higher interest rate. So just be careful. If you have to pay the interest at the beginning of the period rather than end of the period, the interest should be lower at the beginning, because insurance can reinvest those money to earn interest. Let's see an example. Charge interest in arrears and in advance. So if someone borrow $1,000 at 8% per year, the interest due charged in arrears will be $80 at the end of the year. The present value of the $80 in 1 year, 8% is $74.07. If another company charges any rate interest in excess 7.4% in advance, its interest rate is actually higher than 8% in arrears. This can be important, somewhat expensive distinction. So basically what, that's exactly said. So if you borrow $1,000 for a year, so end of the year you pay $80 per interest. So, but if the insurance company said, we want you to pay the interest at the beginning. So beginning this is the present value of the $80 at the interest 8%. This is $74. So your interest rate should be 7.4%. So if you pay advance at the beginning of the year, so basically it's said. Okay, so policy loan usually say the interest rate may be fixed or variable. You borrow a loan against your policy, insurance is going to charge you interest. So is this interest fixed or variable? So most of the time they say it's a variable interest rate. So a participating policy, they has a fixed interest rate, such as 8%, typically include a provision called direct recognition. This is very interesting. Your participating policy. What is a participating policy? It's a policy issued by the mutual funds company. Mutual funds companies owned by the policy holders. They pay dividend to you from time to time. So basically say if you borrow a loan from mutual funds company against your policy issued by this company, so there's something called direct recognition if the interest rate is fixed. So what does that mean? So this provision recognizes that the insurance company can earn either more or less than 8% being charged for the policy loan. And so basically, well, the insurance company loan you the money, charge you 8%. What if they can loan the money to somewhere else, get a higher than 8% interest rate? So basically, if it can earn more, the difference for the policy may be reduced when borrowing taking place. So basically, it's that, well, we loan you $200,000. We charge you 8% annual interest rate. However, if I give those money to someone else, I can get 10%. You know what? The 2% difference, I'm gonna reduce your dividend. I have to pay you dividend. You know what? I'm gonna reduce your dividend to make the difference. So this is very interesting. If the insurance company cannot earn as much as 8%, the dividend may be increased. That's fair. So basically say, well, we give you $200,000 loan, we charge you 8%. We couldn't get, if we we on other market we $200,000, we maximum we can get 6% interest. So it's, to be fair to the the policy holder, they say, you know what, we're gonna credit this 2% interest on your dividend. So we're gonna increase your dividend. So that's fair. So that's called direct recognition. That because it was fixed interest, right? If it's variable, so then your dividend are ordinarily the same. The same whether or not borrowing take place. So if you use variable interest rate on your loan, so your dividend amount won't be affected. So just to keep in mind, when you borrow money against your policy from the mutual funds insurance company, which is a mutual insurance company, so then just to keep in mind that this is something called a direct recognition when you use fixed rate. So if they use the variable rate, so your dividends won't be affected. That's something you want to know. When a policy loan is taken from a variable product, the amount of the cash value equal to the amount borrowed is moved to the guaranteed interest rate account within the policy. The insurance company is accepting the policy value as a collateral for the loan, and as a good business would, it wants those values in secure investment, not one where the value may fluctuate. So basically, it was to say, when you have a variable life insurance, you have the option to choose the investment, right? If you put all your investment in the equity, so it's quite volatile. So when you borrow, let's say you have $200,000 loan borrow against your cash value. So the insurance company said, you know what, we don't want the cash value $200,000 in the equity market. It's too volatile. We want you put in the fixed income. So when you are not pay us the $200,000 back, we're gonna take your money. So that's just your cash value is used as a collateral for your loan.